Well, the bull market in the S&P 500 celebrated its 3-year anniversary yesterday. That was October 12th. And I know many don't like to think back to this time, but the bull market started October 12th, 2022, and this followed a 25% decline when the market peaked earlier that January. The market declined in response to the Fed really aggressively raising interest rates in response to inflation that ultimately hit 9%. And so it's been a few years. Let's see how we're doing compared to other bull markets going back in history. So since the end of World War II, there have been 13 bull markets in the S&P 500. And so far, so good. We're looking at an S&P 500 that is up a little over 80% over the last 3 years. Now, we know one of the themes that we've been seeing here in recent years is this idea of narrow leadership or very narrow concentration of leadership within the S&P 500. And we know so much of the performance has been driven by technology or tech adjacent companies and this artificial intelligence theme. If we actually look at the equal weighted S&P 500 and really just level the playing field for everyone, don't look at things in terms of company size and let those large tech players really dominate their contribution to index performance, we actually see that performance for on an equal weighted basis is about 40% less. So still good, but this is very different than what we've seen in historical bull markets where we've actually seen broad market participation to start. And so that is one thing that's a little bit different this time around. But I guess a few things I would point out about this most recent, this current bull market is the fact that year three, which we are currently in and just actually winding down, up about 13% over the last year. That's about double what we've seen historically in previous bull markets. And I think right now, with the market at all-time highs and really seeming to turn a blind eye to risks that are out there, I think a lot of people are asking themselves, well, at current valuations and knowing all the risks that are out there, is now the time to lighten up on exposure? Should I move to cash? Should I take my chips off the table? We have a neutral allocation to equities and risk assets generally in our portfolios, and we are mindful of the risks. But there's a couple of things. We always say that valuations aren't a timing tool. I think they tell you they help to manage expectations, at least over the short term, when things seem to be priced for perfection. But we also know that age is just a number when it comes to bull markets. If we look at these historical bull markets going back to World War II, we actually see that the average duration is a little over 4.5 years. And the average gain over these bull markets is about 150%, a little over that. And so at 3 years and about 80% in gains, that would suggest that we still have some room to go. And so we would not expect this bull market to end just yet. We certainly wouldn't be surprised to see volatility after the run that we've seen, especially since the April lows. But we think that there's still some time here, and that explains why we are still neutral in terms of our positioning. We look at a lot of the positive gains that continue to come from artificial intelligence, but we are mindful that if this bull market is going to continue, we will need to see that participation in the market start to broaden out. And so that's one thing that we are positioned for currently, and we expect that to happen in the coming quarters. Now, as we think about the potential risks, we also don't want to be blind to the risks that are out there. We're in the middle of a government shutdown, really just to name one. And we are, in a sense, flying blind right now. We're not receiving data as we normally would. The CPI report, the Consumer Price Index, which would provide us with the latest read on inflation, it's due out this week. We're not going to get it. The Bureau of Labor Statistics that provides this number, that number will be delayed. It'll actually come out a week from this coming Friday. I believe that's October 24th. The reason it's coming out, I think many probably have their own assumptions there or beliefs, but what's been said is that this is really to provide the September inflation data that's going to be needed for COLA, or cost of living adjustments that are provided to Social Security recipients. These COLA adjustments are always based on third quarter inflation, and so they need that September number. But I think it'll also be very timely for the Federal Reserve ahead of their meeting, which is at the end of this month, to hopefully show that inflation is softening up a little bit. Obviously, things can change, and so we could be surprised by that number. But the current expectation is that this read will support an additional rate cut at the next September meeting. We are really flying blind when it comes to jobs data. We've seen a number of alternative measures of labor market data come out, and so I think that's really anyone's guess right now. But I think the general consensus is that the labor market is softening, and if we were to receive that data as scheduled, if the government were to shut down, I would imagine we would just continue to see more of the same. Now, in absence of that data, one of the things that we're on the lookout for, and it really starts this week, is third quarter earnings. And so the earnings season gets underway this week in a big way. It actually starts tomorrow, which is Tuesday, with a number of major banks reporting earnings. And so I think that's really going to take the place of this traditional data. Hopefully, these banks will provide us with their read of the economy and how the consumer is doing. And so we'll take whatever information we can get right now. And so I would expect all investors will be really staying tuned for that and any guidance that management can provide as it relates to the broader economy. So I will leave it there for now. Please, as always, don't hesitate to reach out to your advisor if you want to learn more about any of these topics. But otherwise, I'll look forward to catching up with you next week.